Good morning. Welcome to the Monday Market Update. I'm Nash Paradise here with Andrew Cady, and today we're doing group therapy.
Yes, we are. Welcome everybody to the therapy session. Take a seat on the couch. Let's unload what's on your mind. Let me put my glasses on for this.
If you're here and you've been here before, you know what we normally do here. Well, you probably know what we're doing here today. So let's just jump into it, rip the Band-Aid off, and let's talk about what's going on. All right. Yeah, it started 642 last week. This volatility meter doesn't really exist anymore. Just blow it up, nuke it. We've already used the highest of highs, but as you can see, shot up over 20 basis points last week, which is not really a reasonable amount of movement in a single week. On top of everything that we've seen it before, it sucks and it's trash, and it makes me sad. Andrew, anything you'd add to that?
No, it was a rough week in the mortgage rate space. People are still buying. No, we got to keep silver lining in it, but
No, you don't. We can just spend a day being depressed, Andrew. It's okay.
Yeah,
you just sit in this space for a couple hours anyway. Yeah, rates go boom. Let's talk about what happened and why. So jumping into last week's economic news, we absolutely got hammered on PPI. And if you were looking at this and you're thinking, oh man, I wonder what happened last week. Well, clearly it was PPI, right? I mean, we had revisions come up higher. We had estimates and forecasts that were a whole lot higher. And then we absolutely blew through those. So you'd be thinking to yourself, all right, well, Wednesday must have been the day that everything went awful. What actually happened, Andrew?
Yeah, PPI was an absolute disaster. Let's start off with that. Almost three times the estimations. Let's also keep in mind PPI, not all of producer price index, which that's what that stands for, bleeds into consumer price index, but a lot of it does. It's these companies can only absorb so much. And this is on a monthly basis, this is going up. So there is a huge anticipation that future CPIs are going to see the impact of the PPI. We're doing all these, this words today are these PPI, CPI, but yeah, it was super, super ugly. Initial jobless claims on Thursday, not far off. So really, Nash, tell us, what blew this market up?
Friday. It's Friday. We're going to get down on Friday.
And the crazy thing is the experts were calling for Friday to be a really good day. The way the market had signaled at the end of close on Thursday was setting us up for a rebound in yields and to be better. But the markets began to sell off. And I honestly don't really know the inner workings behind it other than oil. And more oil, and oil again, and it got really ugly on Friday.
So from what I can tell, what I can see, Trump had some meetings in China last week, and I believe it was a 2-day meeting, and apparently the markets were expecting China and the U.S. to discuss the Iran, because again, like Andrew said, everything goes back to oil. China and the U.S. to discuss the Iran situation. for China to help advocate to get this ended. And apparently, analysts, stockbrokers, traders, bond investors, everyone was anticipating the war to be, up there on the priority list for this summit. And it wasn't. And it wasn't really discussed much at all. And we came away from the China summit with absolutely nothing encouraging as it relates directly to Iran. And so
it was more like two frat boys just hanging out with each other.
Basically,
they were looking at gardens and looking at the old trees. Yeah.
The general takeaway was that they didn't care. And I mean, that's a fair takeaway. Like, there was nothing positive or proactive that happened in regards to the Iran situation on Friday. Like, you'll see last week's economic news doesn't say, hey, the finalization of this China summit is going to be a big market mover. And yet that was the market mover. We had the worst single day, UMBS loss and increase in treasury bonds I've seen in a long time, pushing through all the technicals way up at this ceiling here. The key levels we're like 7 levels up at this 4.6 now on the 10-year treasury. And, no signs of slowing down, no signs of resistance here. And it's all oil. It's all Iran. It's all this conflict. So that was last week. But the PPI stuff is worth noting because, like Andrew said, if your producer prices are up, that's going to turn, especially to turn up so sharply and so suddenly. If the cost of goods, the cost of manufacturing, the cost of producing things increases sharply, companies can't necessarily make adjustments in real time to shoulder that. That's going to come through to the consumer very, very quickly. And that's why this is such an important index. And that's why it's going to mess with, Fed expectations going forward as we got worse in there and everyone's thinking, oh man, crypto bro, it's going to be all about interest rate drops. Well, just wait. Spoiler alert, rates aren't going down. All right, I told you it was going to be depressing. What we got going on this week in the things that don't matter, because nothing matters anymore, and it's all about things outside of our control that have nothing to do with econ data. Any cool takeaways this week, Mr. Kate?
No, this week is going to be it's heavily going to rely on something that really, in my opinion, the markets haven't relied on for about the past 3 months. It's going to be a real big newsmaker this week, and that's the conflict in Iran and oil prices.
Oh, wait, are you saying the conflict in Iran, the oil prices are going to be primary drivers of overall?
Absolute shocking, Nash.
Okay.
And here's the thing, I know I get technical on this thing, and I like to talk a lot of technicals because I'm a chart nerd. But we're in a range right now in the 10-year treasury that if we crack above 465, 465 is a really important level because it has held quite a few times over the past 18 months. If we crack above that, we will see 10-year treasury yields the highest we've seen them since January 15th, 2025.
Yeah. Been a hot minute on that. I mean, my technical chart right now is showing a ceiling at 466. So basically the same thing.
Yeah, 465.8 or 4.658 is where I'm seeing it.
Yeah, same technicals level. We do not want to break above that. And in more depressing news, we've had 10-year treasuries in this 4.6 mark with overnight average interest rates over 7%. We have held with the instability at 7.25, 7 1/8 overnight average rates with treasuries in this range. So the mortgage-backed securities pricing, the average overnight interest rate, those suckers are holding on for dear life right now. And it's not great. I mean, we're 200 basis points away from the 100-day moving average. We're still seeing stuff move. We're still seeing homes go under contract, but these rates are holding on for dear life. And at a certain point, if we don't get some relief, they're going to crack. And we're going to see increases that are not necessarily in line with additional 10-year treasury movement, because we're just going to have to break out of this hold range and into a more reasonable level over it. But let's just cross our fingers that that doesn't happen. Let's talk about what's going on, not this week, but in regards to the Fed funds rate. This is our ugly chart here. We're getting closer and closer to a rate hike. Last week, we were thinking a rate hike in March. And by we were thinking, I mean this chart that shouldn't mean much looking into 2027. But man, the chart's moving further and further and breaking into levels that are not super cool. What does this mean to you?
I mean, I think a rate hike is somewhat inevitable after that producer price index. And I think it will, the next CPI report, potentially the next two CPI reports, will be the deciding factor, because producer price index isn't what the consumer is feeling yet. So there could be an absorption of that. That could be kind of a one-off report. I think we need to see the next series of reports come out. And if we see another big jump in CPI and a big jump in PPI on a back-to-back report, I think a rate hike is inevitable.
Yeah. Other news, like world news here, Bank of England is saying it does not need to hike interest rates yet, which is interesting. Japan has been holding on for dear life on keeping their rates secured, buying lots of their own treasury bonds. They also hold a whole lot of U.S. bonds. But I mean, this is affecting world economies, of course. This is a world conflict because the world relies on oil. So, I mean, looking forward, we've got PCE coming up at the end of the month on the 28th. That one's going to be interesting because the previous was 2.7. We're already forecasting quarter over quarter at 4.3. And, that's for the core. For the non-core headline PCE, from a 2.9 to a 4.5. When we've got these massive increases in inflation, we're going to see, the likelihood of a rate hike happen. And thankfully, this is all forecasted out into 2027. But this isn't great news for end of the year interest rates and end of the year affordability. When we do see an end to this conflict and we see oil prices go back down to normal, will we see these things check back in? Probably. But the damage is going to be done for a while. Jobs are holding steady. And if jobs are okay, labor is fine, then inflation is everything. So that's why we're seeing this go up to the point that we may, if we hold on too much longer, we may see a rate hike this year, which would
Yeah,
be really weird.
it would be weird, but I almost feel like the markets might react to a rate hike better than we think they would. I mean, let's keep in mind the last few rate cuts, mortgage rates have gone up.
Yeah.
And I do think there's so much unknown about a rate hike, a rate cut. This whole idea of getting Powell out to get Warsh in should be, the Fed's going to be cutting rates. Now they're talking about a rate hike. Markets hate indecision. They hate uncertainty. And I think if we actually just did a rate hike and got it away, it would probably put us maybe in a better spot for finding a stable ground than kind of this middle of the road we're at right now. So I'm not going to sit here and say a rate hike is the worst thing in the world. I think we just have to see how markets react. Let's keep in mind, the last few times they've cut rates, it hasn't helped anything either.
No, but I always counter that in that, when rates get cut and mortgage rates go up, but in the couple weeks preceding the rate cut, things did improve pretty, substantially. And if you look at it over, a whole quarter or half a year, it's like as we got into rate cuts, rates improved. It just didn't improve right when the rates were cut, kind of thing, which, so it depends on which argument you want to make there. Rate cuts are good or bad. But, the econ data that said we needed to cut rates existed. They were there. They were pretty easy to sign off on rate drops. And so, hey, we're moving in that good direction. At this point, all econ data says we need to increase interest rates at the Fed funds level. And I actually agree with you. That was the hot take I was looking for. If we did get a rate hike, it may very well lead to mortgage rates solving a little bit lower. I've seen a couple of people that are real smart have that same opinion, just based on getting some of this stability back in the market and, acknowledging that inflation is high and needs to be controlled. And the Fed is going to be, dialed in to try to keep inflation in check.
Yeah. And so looking at this move we've seen in the mortgage-backed securities, I think it's worthy of noting. This has been a really sharp move. And to kind of explain how sharp this move is, we are currently 100 basis points worse in pricing than the 25-day moving average. 25-day moving average is, hey, what are mortgage-backed securities doing on the average of the last 25 days? So not a huge sample window there. We're 100 basis points worse than the 25-day moving average. We're almost 170 basis points worse than the 100-day moving average. The last time that we saw this type of spread was back in mid-March, March 20th. We saw this massive spread. and it lasted about 10 days before it whipsawed back. So either the moving averages are going to start to trend the other direction, or we could see this thing whipsaw once again.
Yeah, I mean, we're not far from like you just get some good news and cool. I mean, I'm looking at headlines right now. Iran agrees to long-term nuclear freeze in lieu of a complete dismantling. Ominous bond trades point to much higher rates. Treasury yields rise among global bond rout as inflation fears grip investors. Fear, possible, could, agrees. Agrees didn't mean a damn thing. This is all speculation. Everything's speculation. It will continue to be speculation. The good news is, man, if you speculate a little bit the other way, could be cool. But even as we open, this morning should have been another bloodbath. If you were up at 9:30 last night, like I was checking on what was happening globally, like I don't always get online and start checking out Japanese bond yields on Sunday nights, especially on my daughter's birthday. Like it's pretty heavy right now for me to feel like doing that. And man, bonds were reacting very poorly, and we should be in a much worse spot this morning. Thankfully, we get a little Iran news to soften the blow, but I'm already seeing that good feeling gone, like it's starting to erode here a little bit. Where do we go from here? Let's slide forward. I don't even want to look at the interest rate slide. Okay. We've been here before. We were here for a little bit,
Yeah, that's that whipsaw I was talking about right there.
Yep. We go up, we go down, we go up, we go down. Obviously, like it's my opinion, and just me personally as a loan originator, which is 98% of what I do, that hanging out under 6.5 keeps things pretty consistent, keeps things good. Honestly, I like that 6.25 range better. But looking at the last 365 days. When we're under 6.5, things just feel a little bit better. We can get back there. This was a sharp increase, but man, look at how many sharp increases we have. We have tons of them since January. They're all over the place. You got to go back to, July to see, and this is the scary part. You got to go back to July of 25 to see 10-year treasuries look like they do right now. Well, look at July of 25 and where the overnight average interest rates were.
Right.
We are not high enough on the interest rate to correspond with 10-year yields right now.
And the reason for that is because of Fannie Mae and Freddie Mac's purchasing of mortgage-backed securities. If that would cease, we would immediately be back in the 7% range.
Yeah, technicals are saying we should be closer to 7%. So your gift for today, among all this bad news and all this ugly, is we should be worse. Oh, hey, you broke your leg, but you could have lost it. It doesn't feel a lot better. And maybe the bad news there is it could still be worse, and it could still get worse. Like it could still get worse.
That break could become gangrene, and you may have to amputate. You haven't lost it, so let's go down this road, Nash.
Let's do it.
We've had some blood loss. You get a new contract today. Locking or floating?
So I got a $1.3 million contract over the weekend. Nice size deal. And I had quoted him on Thursday of last week.
Ouch.
And so, yep, let him know, hey, buddy, this sucker is about $7,000 more expensive than last week. And my advice is let's get locked in. Let's protect it. There's a lot of room to go the wrong direction. And people buying with these kind of contracts, they understand that it's a long game. They played the long game for a lot of things. And, at a certain point, he's going to be refinancing into 15 years. He's going to sell a home, put some money down on it. And this is not a permanent mortgage product. So rather than try to fight and pay through and, spend the extra money on lower rates right now, we're just going to bump up 0.1% and get some money back that way. It stinks. It's an increase in the pricing. It's not ideal, but it makes a lot more like I'm certainly not floating right now. There's nothing worth floating. That risk, as we've talked about, we could definitely move a lot higher. The market can sustain much higher interest rates than we have right now based on these 10-year treasury bonds. Like we're halfway there. We just need the UMBS to turn to. I'm not taking any risk there. I'm just locking it. And I am trying to tell my agents, like, let's go for some longer contracts, like building out 40 to 45 day contracts instead of 25 to 30, especially in a buyer's market. That may give us some more time and flexibility to see what happens over the next 2-3 weeks. And, look at a float down, look at relocking. There's a couple of strategies that we can utilize as mortgage brokers that can benefit the buyer. but some timing flexibility and like being set, secured, and locked now, but having some length on that contract may work out to make sense for a few people.
Agreed 100%. If you like it, lock it. If your client's okay with it, lock it. If they're not okay with it, strongly warn them against not locking it.
Yeah, no, and it's giving people that choice. Well, hey, if you want, like, people have a bias, and I've talked about this in a couple trainings and coachings that I've done. No one ever expects the bad things to happen to them. It's called an optimism bias. Like, oh well, yeah, this I can drive without my seatbelt, or I'll have a couple drinks and get behind the wheel. Or, I don't look both ways when I'm crossing the street. It's low risk and it's not going to happen to me. No one expects bad things to happen to them because we live in what's also called a present bias, where we don't have a lot of good, forward thinking. So someone who buys 4 houses in 20 years, a buyer, isn't the best prepared person to make a decision on what do they think interest rates are going to happen in the next 2 to 3 months, unless they're way dialed in and like a professional bond trader. They know less than you do as a mortgage professional. And, it's our job to advise people that there is no good reason to believe these things are going to turn around here quickly. And if you floated 2 weeks ago and you're looking at things now and you're really, really depressed at the moment. But if you locked and you're hanging out, you're feeling pretty smart because you locked it when you liked it. And there's not enough going on the market for us to have any kind of future anticipation of what's going to happen. It's going to move on a tweet, an eventual agreement, a deal, an opening of the strait. Like, these are the things that are going to move markets in the next 30, 60, 90 days, not anything that we can try to forecast.
Could not agree more. Well said. Good way to wrap it up, Nash.
Yeah, super depressing Monday. It can only get better from here. Maybe next Monday we'll be real excited. We can talk about this awesome rebound and this boost that we got from, the FOMC minutes on what. No, probably not. But hey, we're going to be watching the tweets. We're going to check out what happens. And we're going to be equipping you with the news that you need to know, so that way you can make sure that everyone in your sphere is surrounded with the right information to make the right call. So tune in next week, and we'll see what we got. Appreciate you, Andrew.
Take care, guys.